You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody, that music means we are back. It is time once again for Education Wednesday. Time for OBC. My name, of course, Mark Longo from the Options Insider Radio Network. Your home now for 19 plus years of options podcast goodness, almost 13 of that with a little show called OBC Riding High. And then, of course, if you want to check out awesome stuff, we did just do that Vol Deathmatch recently. Had an awesome pro Q&A with Mr. Nick Howard talking about all things about scanning and looking for unusual activity and all sorts of cool things you can do to find cool options trades. Did a bunch of that yesterday. You want to participate in that? You want to do some of your own unusual trade, and a lot of that going on Options Oddities on Fridays. The only place to get that, theoptionsinsider.com/pro, is the place to go. Coming up to the end of February, listeners, get your name in the hat so you too can win fabulous prizes as we go around the horn, see who's joining us on this fine, fettered Education Wednesday. None other than the black-hatted one himself, Daniel Columbus Passarelli III, Esquire. You know, he likes these explorers. They're always sneaking into his name somehow. Mr. P, welcome back to the show, sir.
It's good to be here. I'm feeling fine and fettered, as you know.
How goes your various sailings from Spain to the New World, sir? Going well?
Pretty good. Yeah, the Dramamine kicked in.
Yeah, you need it about halfway through. It gets a little bumpy. Gets a little rough there. But then the second half, I find smooth sailing. Right on in to the Americas as we slide right on into a little bit of the old options drills.
All in boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, let's get down to a little bit of options drilling. And Dan, we thought we'd explore a topic we've touched on a few times in the past today and do it in a little bit different way, which is always kind of fun. Today we're talking earnings season, and we kicked it off at the beginning of the week, Dan, because it still is very much in the throes of earnings season. In fact, a big name, some might say the bellwether for the entire market these days, good old Nvidia popping off this week. So still a lot of big names popping off right now. And earnings season, obviously, a regular fixation, I know, for a lot of options traders out there. And it's been a frequent topic for us. We've done a lot of data. In fact, our website's still, I would say, the best, certainly the best free source for options data going back now many years we've been crunching this data for you, listeners. So get on over to the website if you want to get some great free analytics on what's your favorite tickers, what they're pricing in, how much they've moved in the past, all sorts of good stuff. But Dan, we thought we'd ask our audience this week, how do you tend to approach earnings season with your options trading? Very straightforward. Only gave them 3 choices. They sell premium, they buy premium, or they avoid earnings altogether. Dan, which way do you think our audience is going? And then in general, you and I have discussed it before, but which way is your preferred vector when you're slinging some earnings trades, sir?
Oh boy, man. I think, first of all, I like the choices, so it's not, I'm bullish, I'm bearish or anything like that. I am going to guess that our audience tends to avoid earnings.
I wouldn't have guessed that at first, but Dan, coming into the start of the show now, nearly 70% of the respondents, 68.8%, saying they avoid earnings season altogether. 25% go to the dark side, which is they sell premium, and 6.3% say they buy premium. Now, I will say, specifically through the lens of Options Bootcamp, that is probably the approach that a lot of listeners of this show should take. You should probably avoid earnings season. It's a crapshoot. You don't need to add that risk to your life. Avoid earnings season with your options trading if you can avoid it. But for a lot of you out there, I know this is an intriguing time. Dan, when you're doing your earnings trading, I know you do different approaches. You like to do calendars in particular. Would you say, in general, you lean short or long juicer?
Yeah, definitely. I am most often a premium seller, which, I mean, honestly, I consider doing calendars being a premium seller, even though you end up net long Vega, but you're just, you're short the volatility that's the highest, that should collapse the most. So I look at it as a premium selling strategy, even though it's positive Vega.
Interesting stuff indeed, Dan. Well, yes, I was kind of surprised that our audience avoided earnings. I have to say, in general, I do fall. I would say if I do trade earnings, I do fall in that 25% selling premium camp. That is mostly the way I like to do it because we've talked about many times implied vols get pretty inflated heading into earnings. If you have a particular name, particular outlook you have on that name, maybe you just want to kick off the wheel and you want a nice juicy way to do it. Earnings can be a good starting point for that, which is why I tend to lean dark side. It usually starts with that first leg of the wheel where I'm selling the put at a strike that I particularly might like with that stock and at an implied vol level I usually can't get. So that's usually an attractive combo for me, which is why I tend to lean dark side. I'll have to go think the last time I leaned long premium. You know what? Now that I think about it, it probably was. We've been experimenting with those intrinsic value butterflies on our Options Oddity show on the Pro, which is where you're effectively trying to buy the butterfly for a net outlay that is equal to or less than how much that first leg is in the money. So if the stock is trading $9.50, and let's say, just for the sake of argument, you do 9, 11, 13. I don't usually like symmetrical flies, but let's just say it works out that way. Then you want to buy that fly for, let's say, under 50 cents. And then you have that first leg for less than the intrinsic value that it is actually worth. So I would probably say that's the last time I was long premium going into an earnings event, would be something along those lines. Like you, Dan, I've been doing a lot of calendars lately as well, which means I'm short near dated juice and I'm long the longer term juice out there. So yeah, I do carve it up a lot of different ways, but I would say in general, I tend to lean long, and it sounds like our audience leans the get the hell away from me. Dan, they don't want to touch earnings with a 10-foot pole. That kind of surprised me, but again, I think for a lot of listeners of this show in particular, that makes a lot of sense. Which brings me around, Dan, to the theme and the focus of today. We've done a few shows in the past where you and I have gone head to head with our robot overlords and struggled for the dominance and indeed the future of our civilization. Dan, are you ready to do it again?
Let's do it.
Yeah, we kicked it off. Round 1 of our battle against the robot overlords was back on December 11th of 2024. It was episode 318, entitled this is just to throw them off the scent, Dan. We called it, we welcome our robot overlords, but we were really there to overthrow them, Dan. It was a little bit of sneakiness on our part. And then we did round 2 last November, so nearly a year later. Episode 365, we went against AI, talking about prediction markets and a bunch of other fun stuff on that episode. So if you want to hear Dan and I battle AI on previous episodes, those are 2 you could check out. And this time, Dan, we're mixing it up. We're changing. We're not just doing general stuff. Last time we talked about, what should we focus on when it comes to options education, and then what should we focus on in general? What are the hot topics and things that people should be focusing on and aware of in the options market right now? This time we're getting very specific. We thought we'd see how AI fares, Dan, on that exact question that we just asked to our audience. So we went to AI, and this time we like to usually do an array of different AI sources. This time we just stuck with one for simplicity's sake and to make things kind of even, and otherwise it'd be many days collating all this data, Dan. And maybe we'll expand it on future shows. We went with this time with the premium, the high-end version of ChatGPT. So that way we would have at least as up-to-date as you can get data with some of these models. I know sometimes timing is a bit of an issue, lagging data with some of these models out there. We went out, we asked that premium ChatGPT, we said, how should I approach earnings season as an options trader? And interestingly enough, Dan, with these high-end models, they ask you to train it. So they actually gave us several different responses and asked us to choose which one is the best. So there already is a little bit of selection bias going on here, Dan. We chose this was the best of the 3 responses. Dan, you ready to hear what the robot overlords have to say for how we should trade earnings season?
Yeah, I'm pretty interested to hear.
All right. So their response, Dan, was that earnings season is high risk, high opportunity. And they put that all in caps and bold. For options traders, the edge comes from structure and discipline, though, not trading direction. They say, here's your framework, and they have multiple steps. Step 1, Dan, know what you're actually trading. They say earnings does not equal will it go up or will it go down. So in that case, I like it. They say you're actually trading implied vol, expected move, and the post-earnings vol crush. That is interesting. I have put this into a few other models recently, and a lot of them do hit on this post-earnings vol crush. So that is an interesting thing that wasn't very widely known, I would say, even a few years ago. They put here as their summary for step 1, Dan, most options lose even if you're right on direction. What are your thoughts on step 1 and that last little caveat there, Dan?
Yeah, I mean, I've seen so much of that. Oh my gosh. I've, be it on the front lines, talking to retail traders who are trading out there. I see people say, oh yeah, I've got this strategy where I always, buy calls going into earnings or whatever, and it works great. And then you talk to them 3 months later and they're like, yeah, no, that doesn't work. So yeah, I'm glad to see that AI is at least so far pretty on the money here. I'm glad to see that.
Yeah, I don't hate their step 1. Most options do lose, especially if you're going long premium. That is definitely correct post earnings. So that's a challenging way to go. We said that many times, which is why probably only 6.3% of our audience goes long premium into earnings. That said, our data does show the last, I would say, year and a half, buying juice in aggregate was the right way to go on earnings season. They were outperforming like mad. So bear that in mind, listeners. This is the first time. We always used to say, oh, always sell juice going into earnings. These days, I would say it's leaning by, but we'll get into that a little bit later. Step 2, Dan. Start with the expected move, Dan. They say this is non-negotiable. This is something you have to do if you are trading earnings as an options trader. They say before you do anything, you need to go calculate that at-the-money straddle, see what the predicted move is. They give you an example. Stock at $100, the call and the put are both $5. That's $10 for the at-the-money straddle, aka a 10% move in the underlying is expected. And they say this number decides everything, Dan, and it is non-negotiable. I'm curious, is that your starting point? I know for some people it is. I know for Overby, that is his starting point. He likes to construct a lot of broken wing flies around the at the money, and he uses that straddle as very much his starting point. Is that the starting point for you?
That is not the starting point for me. I find, I mean, this is sort of like another way of looking at implied volatility in a way. Um, and my starting point is that implied volatility is wrong. So I hate the word expected in the phrase expected move, because that's not a real thing. That's what's priced in, but it's not what's quote unquote expected. So no, I'm diverging course with AI at this point.
Yeah, I think I would diverge on that one as well. I do look at the straddle and it is part of my analysis, but it is not step one. It is not step two. It is not non-negotiable. It is not my starting point for every earnings trade. It comes into my calculus somewhere down the road. If I'm looking at selling a put, let's say, to kick off the wheel, I will look at what that straddle is trading to just to see kind of what the market is pricing in, and maybe that will help me in some of my strike selection. But it is by far not step one in determining my strategy or how I'm going to approach it. So I would say it's definitely something you should be cognizant of, but saying it's non-negotiable, I don't know. I might give that a thumbs middle or a thumbs down for AI for that one, Dan. Step 3, choose the right strategy, Dan, based on your view. If you expect a big move, they say this is rare but sometimes valid. You should go long, straddle, or strangle. Interesting. Needs a move bigger than the expected moves. Yes, you do need to outperform your straddle there. You have to buy it close to earnings, sell fast after. I would say that's definitely probably the way you want to do it. You don't want to ride that for too long, unless you want to do the theory that some folks have of you buy that juice, let's say a week to a week and a half ahead of time, and you try to ride it because there isn't a ton of decay heading into earnings, and then you get out of it before the event itself. But then you're not really trading the earnings, you're trading the lead up to earnings. That's a bit of a different conversation. And then they say small position only. I do like this kind of takeaway they have for step 3, Dan. They say most traders overuse this and bleed slowly. And I would say, yeah, you really need to be cautious with this approach. I know you've gotten more into straddles lately. You're kind of more of a straddle buying guy than I am. But this, as they say here, if you do this wrong, it's a death by 1,000 cuts, or sometimes post earnings is a death by a big vol crush, Dan.
Yeah, I mean, it's always been the case with straddles that you really got to pick your spots. And it is still the case now, even though, straddles have been a little better over the last couple of years, earnings wise and otherwise, but there's still a strategy that most of the time you should plan on losing most of the time. And I mean, AI here says most traders overuse this and bleed slowly. You should know that you will bleed slowly and you win on those home runs. It's a very downhill bumpy road for a while, and then rocket ship, and then down again. So yeah, I mean, I would say maybe 1 out of every 25 of my earnings trades are buying straddles, I would say, these days.
Yeah, I can't remember the last time I just went straight long a straddle going into an earnings or even a strangle. I'm usually selling something else against it. I like the defined risk of that. I like selling something else to defray my outlay. They are right. This is really only for if you expect a home run move. This is you're heading into tariff tantrum day last year, Liberation Day, and we're going somewhere. Then you can put on a long straddle and probably do all right. But outside of those mad times, you got to really be convicted that something big is coming. If you expect a normal or muted move, which they say most cases, to be fair to them, they say this is the normal way you should probably approach it. They say premium selling strategies, iron condors, short strangles. They say that's advanced. That might be a little risky. And then credit spreads. Why? They say implied vol is inflated. You profit from the vol collapse, and you don't need direction. And they put a caveat here, or they put a little addendum, Dan. This is where the professionals live. I would agree. Most professionals probably approach earnings from a premium selling way. Iron condors, those are risk mitigated. Short strangles, a little wild, Dan. What are your thoughts here on the premium selling approach they're advocating here?
Yeah, I mean, I would I would tell our listeners, leave that to the professionals. I mean, it is a thing, but it's a thing that every now and then is really going to kick you in the nuts. So I don't know. Uh, I know people who do it who are really, really good traders, and that's okay. But you just gotta know that every now and then there's going to be one of those black swan events. I don't even know if you can call it a black swan event with earnings, because that it's going to happen every now and then. So I don't know. I really like the defined risk trades. Also, I would throw in their time spreads as well, with iron condors and credit spreads. But yeah, defined risk, I'm all about that with earnings.
If you have a directional bias, you can use defined risk spreads, going back to what we were talking about earlier, not naked options. They say call debit spreads, put debit spreads. Why? Again, lower implied vol. They're cheaper, less crushed by volatility. So Dan, this gets back to what we were talking about. If I do go long premium, it's probably going to be in one of these defined risk type strategies. Again, very rarely am I just rolling the bones on a long straddle or long strangle. It's got to really be like Nvidia. I see our chat talking about Nvidia after the bell today. Nvidia, if I'm going to go long an Nvidia straddle, Dan, this has got to be a banger. I haven't looked to see what they're pricing, but I'm sure it's a heck of a lot of juice. Now, the game does change because we do have the 0-day contracts now. So you could play a little bit more bite-sized bite at the apple if you wanted to do that. So that does change the game a little bit. All right, we talked about directional bias. Step 4, Dan, is timing matters more than people realize. They say implied vol rises into earnings. That's generally true. Implied vol collapses immediately after. Also generally true. They say best practices, Dan. Premium sellers, if you're going to sell juice, enter 1 to 5 days before. Premium buyers exit fast after earnings. Avoid holding the long options position post-announcement. And they say something to pay attention to here. Overnight risk is real and gap risk is brutal. Dan, what are your thoughts on step 4 and some of their takeaways? Premium sellers 1 to 5 days ahead of time. Buyers get out right after the announcement, and avoid holding long positions through the announcement if possible. Post-announcement, I should say.
Well, I'm with her on 2 out of 3. Definitely avoid holding, well, long or short options post-announcement. Like far post-announcement. Definitely, if you have a long option, get out before the announcement. For premium buyers or premium sellers, I say exit fast after earnings. But here's the rub. Like I enter literally the last hour of the day of the session right before earnings. 5 days before is a gosh darn eternity. So much can happen. You're just adding wild card risk if you enter 5 days before. So I don't know. I think ChatGPT here didn't put her money where her mouth is.
That is a long way to go. If you're going to sell juice ahead of earnings, I think closer is probably a little bit better. You want to get that crush and get the heck out of Dodge. You don't want to usually. In fact, we were talking about a trade with HIM's earnings going short premium on our Options Oddities show on the Pro on Friday. And HIM's was, I believe, after the bell on Monday. We said there's no reason to do this trade now. Why would you do it on Friday, ride it through a weekend where any crazy thing could happen if the announcement you're looking to trade is after the bell on Monday? Do it on Monday if that's when you want to do it. Get your best level then, and then ride it through your event if you want to do it, and then live to fight another day and hopefully make some money. And if you sold juice, I know a few of them did, in HIM's, it worked out pretty well. So interesting stuff here. Yeah, I would say that one, I would say the premium selling one I might take some issue with. The premium buying, you do want to get the heck out of Dodge pretty quickly. I will go along with them. So I'll give them a middling on that, Dan. Number 5, position sizing. Don't blow up. Earnings trades should be small, 1 to 3% of account risk max. Okay. They should be defined risk, which is interesting because they were just talking before about going along a lot of straddles and strangles and stuff. That's not really defined risk. And then selling strangles, which is also not defined risk. And then treated as probability bets, not convictions. They say if one earnings trade can ruin your month, then your size is wrong. I can get behind that. I don't know if they're preaching defined risk here where they weren't earlier, Dan. So maybe they lose some points for continuity, Dan. What do you think?
Yeah, that's kind of weird, you know. I mean, sometimes AI just goes down these rabbit holes, and it's like the more you keep asking questions, the further they diverge from what you said before. So I don't know if that's what's going on here or what, but I do like keep the risk of each trade small. 1 to 3% of account is about right. And yeah, they're definitely probability bets and not convictions for sure. That's the whole point of volatility trades like this.
I like everything else except for the fact that they say defined risk, which I agree with, but they don't say that earlier in their thing. So again, they lose some points for continuity there. Step 6, Dan, this is your checklist, your pre-trade checklist. You have to check these before every earnings trade, Dan. Is your implied vol high or low? What's the expected move? That's a necessity again. Part 3 is how did the stock move on past earnings? Which again, I think the only place you're going to find that is on our earnings data on the website, unless your broker really has some good data for you. Also, am I selling or buying vol? If you don't know that, you shouldn't be trading earnings. And then what's my max loss before I enter? If you can't answer all 5 of these, Dan, then you should skip the trade. What do you think?
Yeah. Is IV percentage high or low? I mean, obviously that is the whole point of the trade. What's the expected move? I mean, I don't know. To me, that's just silly. That phrase doesn't mean anything. I mean, I guess if you're taking that number and change the words because it's not the expected move, it's the volatility level, then okay. But even translating it into what that volatility standard deviation comes out to, I mean, standard deviation isn't the move that's expected. 2/3 of moves fall between up 1 standard deviation, down 1 standard deviation. It doesn't mean the market thinks it's going to move that much. It's just, I don't know. I just take big issue with that point. And how did the stock move on past earnings? Super important. That's a big part of my strategy for sure. And then am I selling or buying volatility? Of course. And what is my max loss before I enter? You always know that. So what would she give us? 5 points? Yeah, I'm 4 out of 5 with her.
And here's their takeaways for you, Dan. The 7 biggest mistakes to avoid. Don't buy weekly calls because it'll beat earnings. They say don't do that. Another mistake, you're ignoring the IV crush. Don't do that. You don't want to ignore that. You do that at your peril. Oversizing, I can get behind that one. Holding long options after earnings. Yeah, that's usually a no-no, so I can get behind that. And then trading every single earnings name outside of the Citadels of the world. I don't know who's trading every single earnings name, Dan. So that'd be a mad person if you were doing that. They say you don't need volume, you need selectivity. So I can get behind their big mistakes to avoid. And then they're too long, didn't read, Dan, that they say the pro move for this. Boil it all down, all of their collected wisdom. It's this, Dan. Most of the time, sell premium defined risk, which again is not exactly what they were saying in the steps 2 to 4. They need to go back and check their own work. They say sometimes do directional spreads. That's kind of interesting. You rarely do long volatility. Yeah, I can get behind that. Always respect implied vol, size small, and plan your exit. So, yeah, I think they did a decent job for the most part, Dan. I give them a middling to a modest, maybe thumbs up. The only issue, like I said, I would have is the continuity of their message. They seem to kind of lose the thread a little bit there. I think in general, if they were talking mostly about being defined risk just about all the time, with the exception of those really, really explosive home run moves, then yeah, I could get behind it. But in general, I think they did all right, Dan. What do you think?
Yeah, I mean, the only one, I guess I would want to kind of shoot the breeze about this one with her. Sometimes directional spreads, that sometimes ought to be pretty darn infrequently, and it ought to be a generally neutral spread, maybe with a slight bias, and specifically to the upside. I mean, I haven't I haven't done a study on it in a while, but more stocks go up after earnings than not. So I think there's a slight bias to the upside sometimes. But I mean, I wouldn't be like, oh yeah, 10% higher, 5% higher. I mean, it would be if I'm trying to pick a neutral spread and I'm doing like a calendar, gun to my head, I got to pick a strike below where the stock is or above where the stock is. I'll lean towards above where the stock is. But so yeah, I mean, I agree with the too long didn't read, except for the directional part.
Yeah, the directional stuff, they don't really touch on that in their other steps that much either, which is kind of interesting. So yeah, a little bit for continuity. But in general, yeah, I think if you keep your sizing small, you lean dark side a lot of your trades with the particular, maybe you think something's really going to be a hit, then you go the long premium route. If you go long premium, you keep your outlay, your risk mitigated, I think, and you get out, as I mentioned, right after the event itself. I think you could do fairly well. I get that. That said, though, the data recently has been leaning towards more long side trades, so it's something to bear in mind. And again, if you want that data, I'm not really familiar with any other sources that give you as much data, certainly for free, as we have over there on the site. So by all means, check it out if you are intrigued. Now, Dan, as I was going through this AI, at the end of the day, I'm always kind of wondering, which, by the way, I thought it was interesting. You several times referred to the AI as her. Why is the AI female in your mind, sir? Because you're used to your wife giving you orders, so you're used to the robot telling you what to do. Does that make sense?
No, I don't know why. It just seems like it's a her. I don't know. I don't know why.
A lady. All right. I'm reading this stuff and I was like, at the end of the day, you have to wonder with all these models, where are they really stealing this stuff from, right? Because at the end of the day, that's what AI is doing, is kind of just scouring the internet, compiling all this data and regurgitating it to you in some sort of digestible format. There's not a lot of real true intelligence going on there yet, at least for a lot of this kind of thing. There will get a point, I'm sure, where that is the case. But right now, it's really kind of just an advanced search, which is obviously why Google saw the threat in it and jumped into that fray with Gemini. But I was reading some of this. A lot of this sounds familiar as what a lot of people we know preach. So I said, where are you pulling this? They obviously ripped off Macmillan. They obviously ripped off Natenberg and a bunch of other things. So we said, where did you get this data from? And they pretty much admitted, yeah, we ripped off Natenberg and we ripped off Macmillan. They cite those as two actual sources. They cite exchange education research from the SIBO. So they ripped off the SIBO there as well. Empirical broker research from our sponsors here, Tasty Trade. They ripped off a lot of their data, as well as Thinkorswim. So they ripped off the Schwab platform as well. They say academic volatility math and real-world trading practice, which they also cite market makers, cite how market makers do things. And I said, how do you know what market makers do? That seems to be a bit of a bridge too far for an AI model to know. And they said, many market makers, traders, and vol professionals have publicly explained their approach over the years via books, they put in parentheses, written by former market makers. So what we had to ask then, Dan? We said, okay, did you rip off the black-hatted one? Did you use any data from one Daniel Passarelli III, Esquire? And they said, yes, but indirectly. They said indirectly, not as a primary source. They said, your books reinforce and clearly explain core options mechanics that are part of the framework they used for setting up how they do implied vol versus realized vol. And they say, your relevant books, Dan, if I was curious, are Trading Options Greeks and The Market Taker's Edge. They say these books are excellent at translating professional concepts into retail usable mechanics, particularly Greeks and vol behavior. So the lady AI seems to like you, but it says they did not rely on you as a source for some of the expected move stuff they did. They pulled that from Natenberg and SIBO, and the earnings vol studies that came from Tasty Trade. And the market maker framing, they said, came from Natenberg and Sinclair, and then Exchange Materials. So they say you support it, and validate their framework, but you weren't a primary source for them. So I guess you can be happy, Dan, they didn't rip you off.
Yeah,
they just tangentially ripped you off, sir.
She's hedging. Must not want to be part of a class action lawsuit like they have against Anthropic.
But they said nothing they said contradicts with your books, so they wanted to point that out. They say they're very consistent with Dan's work. And then just for fun, because I know a lot of our stuff is still behind that wall of audio, which thankfully is still inaccessible to a large number of these. I mean, I think there's a lot of other low-hanging fruit that these models are going to scrape and grab first before they go through the effort of transcribing all of our 19 plus years of shows, Dan, thousands of hours, and then making that some sort of searchable format. But we do have 19 years worth of info on our website that they could certainly steal. And so I just put it in for curiosity. I said, did you guys use any, or I should say really borrow any of our stuff out there? And it was kind of freaky. They did cite me by name, saying I do talk a lot about these kind of things on the show, which is always kind of scary when the lady bots cite me by name, Dan. And they say we do have a lot of market makers on our network. So clearly the bots are listening, Dan, which is a little bit freaky. They say we feature guests from SIBO and market makers and Valdes. So a lot of the stuff we talk about is also concepts that they have used in here, but they don't point to any specific episode, thankfully, anything along those lines. They say we discuss a lot of these same concepts that they pulled on here, applied vol and everything else. So the robots are listening, Dan, and the robots are watching, and they're kind of doing the low-hanging fruit right now, which is nice. Our stuff is still a little bit safe. We got a few more years, maybe, Dan, before your lady bots come for us as well. They've already gotten your book. The text is easy. They can get all the text. Just consider all the text is already stolen. The other stuff takes a little bit more hoops to jump through. Maybe you have a little bit more barrier to entry. But yeah, wild stuff here, Dan. So far, in general, what grade do you give the AI in our round 3 of boot camp versus AI, sir?
I mean, I got to give for a good solid B, right? I mean, you can't really be too big of a hater or anything. I mean, he's pretty aligned with, well, I guess she's mostly aligned with conventional wisdom, because getting all the conventional wisdom from all over.
She is literally conventional wisdom. That is what the AI is right now. It is the conventional wisdom on this, as stolen from a number of widely available sources. But in general, right now, when it comes to topics like this, it is still just kind of an aggregation, if you will, of just a variety of kind of low-hanging fruit sources and kind of spitting it out in some sort of digestible way, sometimes with some issues with continuity. So it shows they don't fully understand yet what they're putting out there, but they know it should be like this and it should be in this type of order. And that's the way, at least Dan says, the lady bots are putting it down. All right, Dan, that music means we've come to the end of a pretty fun one, I think. It's always kind of fun to see what the AI thinks. And also, this is something other people should be doing too when you're using AI models. Press them on their sources. Say, where are you taking this info from? Where are you grabbing this from? I can tell a scrape when I see it. Where are you scraping this from? How are you using it? What are your thoughts? Especially when they're referring what market makers say and do. That was a little surprising to me. So I need to do a little bit more digging on where they source their market making info from. Because if you know market makers, Dan, they're usually a pretty closed-lipped bunch. They're not out there talking to the bots very often. They do talk to us, though, and the bots are clearly listening. So some of that going on out there. They say they also monitor conference talks, university lectures, and exchange education programs for market maker info. So kind of interesting, Dan. This proves, Dan, the bots are listening, Dan.
Apparently they are. I'm not surprised. Not surprised at all.
And if folks want to listen to you, Dan, where should they go? What should they do? Instead of asking the bots to tell them what Dan Passarelli thinks, if they want to go to the primary source, where should they go? What should they do?
Yeah, I mean, I'll tell you what, hit up my Substack, and that is where you can get links to other things that I do. That's where you can get articles, some complimentary, some are subscription articles. But yeah, hit up my Substack, which is Wealth Building with Options. You just go to Substack and search for Wealth Building with Options, or me, Dan Passarelli.
And of course, if you want to see the other primary source that the AI bots ripped off, check out our sponsors, tastytrade.com/podcast. It must be good. The bots are ripping it off as well. And I know they do have a large archive of research they've done over there as well. If you want to kick the tires and light the fires, the bots like it. You're probably going to like it too. tastytrade.com/podcast. If you want to learn more, Dan, our chat, like I said, is talking about Nvidia earnings And Nvidia trading a little bit shy of $200 right now going into earnings tonight, Dan. And they're talking about the 265 strike has traded 3,100 times today, Dan. With a penny wide spread, 265. So that gets back to what we were talking about. Wild earnings trades.
Wow.
You want a 265 call expiring on Friday for not even a penny. I think you got to pay 2 cents, Dan. What do you think?
Oh my gosh. That is crazy.
They're a penny bid out. You got to pay 2 cents, sir.
Oh my gosh. And those are the ones that expire tomorrow?
They expire Friday.
Goodness gracious.
No, obviously we know no earnings 0 days on the actual day of the earnings announcement. That was their one concession to the regulators. No 0 day Nvidia on earnings day, for example. So you're not going to get your Wednesday weekly expiring today. Yeah.
Yeah, that's right.
So outside of that, you got to go to Friday, listeners. So all the way to Friday for 2 cents, 265. Man, that would be a while. I wonder what the AI bots say about that, Dan. They're like, don't do it. But that is going to do it for us on OBC. If you want more Dan in your lives, it's another Dan Squared Palooza here on the network, listeners, as we'll be joined in a little bit by our good buddy Dan, the man, Gramza. I'll have to see what he thinks about the AI overlords and their thoughts on futures. We will be talking futures on the Futures Rundown. And then we're back after the closing bell with the Hot Options Report, the latest addition to the network. Had Mr. Nick, the creator of all that data, on our Pro Q&A yesterday, talking about some really cool scans and badges and unique stuff you can do there that is really kind of cool, trying to make options analytics accessible for everybody. I think it's like $1.10 a day, something like that. It's ridiculously cheap. So if you want some great data, a lot of these platforms we use hundreds, if not thousands of dollars a month. This one, a little bit cheaper. So something to check out there as well if you want to check out the Hot Options Report. It's actually the name of the URL, thehotoptionsreport.com. I'll give them a free plug here on the old show. Great data, and you can't beat the price, that's for sure. And then, of course, we're back with our usual array of content throughout the rest of the week until we're back again next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.